Hi, I'm Garrett Cayet, SFMG's Chief Investment Officer, here to check in around the halfway mark of 2023 and provide some thoughts on how we're looking at the second half of the year. So in the second quarter, we saw some positive developments across major stock indices for a few reasons. The Federal Reserve briefly paused their rate hiking campaign. We saw some pretty resilient economic data. Corporate earnings were beating expectations, mostly in the tech sector, and a resolution to the US debt ceiling provided some relief to the markets as well. And through that, the S&P 500 reached a 14-month high in June and was up 10.32% for the quarter. Notably, though, those gains were primarily driven by a handful of mega-cap tech companies, and in fact, most other US sectors actually experienced negative returns for the quarter, but that tech sector performance was enough to push the markets higher. Now, touching on the economic data, things have been largely better than expected. For example, new home sales rose over 10% year over year in both April and May. Personal income figures, including wages, have continued to grow, which has led to continued consumer spending. And the labor market has remained strong with roughly 300,000 jobs added in both April and May. So as we get into the second half of the year, despite some positive trends, we are still mindful of the potential risks that are still out there. Uncertainties around inflation, lingering regional bank stress, and concerns in the commercial real estate sector, to name a few. Perhaps most importantly, we believe the full impact of the higher interest rate environment that we're in has likely not been fully felt by the economy, and as that continues to filter through, we shouldn't be surprised by any slowdown related to that in the second half of the year. In light of all this, while we are very pleased with the market performance so far, we're focused on managing both risk and return potential. So our portfolios continue to emphasize areas of the market that stand to benefit if the tech sector fueled rally subsides and market sectors with more attractive valuations begin to take the lead. Thank you for listening, and if you have any questions, please feel free to reach out to your SFMG team. Thank you.